Right now, while institutional money is piling into NVIDIA at nearly $900 per share, and Microsoft is trading around $400, there is a group of AI stocks trading under $5 that most investors aren't even looking at. And here's the crazy part. Some of these cheap AI names have already posted triple-digit gains this year, landed contracts with organizations like NASA and the U.S. Department of Defense, and are building technology that big tech actually depends on. Make sure you watch until the end, because the third pick on this list has hardware critical to AI data centers and has just received a significant purchase order that basically validates its entire business model. So if you are ready to look beyond the crowded megacaps and see AI opportunities that Wall Street hasn't fully priced in yet, let's dive into 3 stocks that deserve your attention based on verified financial data from December 2024. Before we get into specifics, let's set some expectations. When we talk about AI stocks under 5, we are in penny stock territory, and that classification exists for a reason. These companies usually have smaller market caps, higher volatility, less liquidity, and significantly more risk than established tech giants. A $1 move on a $4 stock is a 25% swing in a single session. That volatility cuts both ways. You could see significant gains, but you can also see painful losses very fast. This video is purely educational and informational. I'm not a financial advisor. Nothing here is personalized investment advice. You should always do your own research, read SEC filings, understand each business model, and never invest more than you can afford to lose entirely. The SEC classifies stocks under $5 as penny stocks, which come with heightened risks, potential manipulation, lower trading volume, and limited analyst coverage. With that foundation laid and expectations set, let's look at 3 AI stocks trading under or near 5.5 that stand out for verifiable performance, real contracts, and genuine technology. The first stock is BigBear AI, ticker symbol BYBY, currently trading around $6.56 per share. Technically, that's slightly above our $5 level, but it has been under 5 recently and behaves like a penny stock in terms of volatility and risk, so it fits this discussion. BigBear AI provides AI-powered decision intelligence solutions primarily for national security, supply chain management, and digital identity. What makes BigBear interesting is who they sell to. Their customers include U.S. defense and intelligence agencies, border protection, transportation security, and commercial sectors like manufacturing, logistics, travel, entertainment, and tourism. Government contracts provide a degree of revenue stability that many speculative AI companies simply don't have. In 2024, BigBear reported about $158 million in revenue, a 2% increase from the prior year. That's not explosive growth, but it is positive in a challenging environment for smaller defense contractors. The stock has had a strong run recently, up roughly 47% year to date, and about 94% over the past 3 months, according to Yahoo Finance data. 2 analysts currently covering the stock rated a strong buy, with an average price target of 7. That is modest upside from here, but it does show professional confidence in the company's direction. BigBear also acquired Ask Sage, a generative AI company, a $250 million deal to expand its AI capabilities for defense and government clients. That move signals they're serious about scaling their technology stack. Now, let's talk about the risks. BigBear's revenue growth has been inconsistent from quarter to quarter. In some quarters, revenue actually declined as specific Army programs wrapped up. The company is still not consistently profitable, with total losses of nearly $300 million in 2024. That is a severe cash burn and creates real financial risk if they can't move toward profitability. The stock trades at a rich valuation relative to its revenue, around 9 times trailing sales, compared to a historical average closer to 3 times. That means the market is already pricing in aggressive future growth that hasn't materialized yet. If revenue doesn't accelerate, or if government spending changes and hits its contract pipeline, the stock could pull back sharply. The bull case is that defense spending on AI, analytics, and decision support remains a priority regardless of politics. In this niche, customers care more about reliability and security than saving a few percent on costs. Once you're embedded in defense systems, switching costs can be high, which creates a bit of a moat. If BigBear can successfully integrate Ask Sage, win new contracts, and grow its commercial business so it's not so dependent on government revenue, there is meaningful upside from current levels. But it's high risk, high reward. The second stock is POET Technologies, ticker symbol POET, trading around $6.12 per share. Again, slightly above $5, but still in that lower priced, high volatility zone. POET operates in the semiconductor space, focusing on photonic integrated circuits and optical engines for AI data centers, built on its proprietary POET optical interposer platform. Here's why that matters. As AI workloads explode, data centers need to move vast amounts of data between chips and servers as quickly and efficiently as possible. Traditional electrical connections are starting to hit speed and power limits. Light travels faster and with less loss than electrical signals. That's where photonics comes in, using light instead of electricity to move data. For next-generation AI infrastructure, photonics is increasingly seen as essential. POET's technology integrates electronic and photonic components onto a single chip via wafer-level manufacturing. This isn't just a white paper idea. They have partnerships with major manufacturers like Foxconn Interconnect Technology and Luxshare, both large global electronics players. In October 2025, POET received a $5 million purchase order for its Infinity optical engines. For a small-cap company with a market cap of around $175 million, that's meaningful validation that customers are actually buying and deploying its products. The stock gained about 195% in 2025, outpacing even NVIDIA's roughly 150% gain during the same period, according to Nasdaq reporting. POET was also recognized as the best optical AI solution at the 2025 AI Breakthrough Awards, which is a third-party validation of its approach. Hyperscale data centers spent around $112 billion on semiconductors in 2025, almost double the previous year, and that figure is expected to keep rising as AI infrastructure expands worldwide. POET is targeting speeds of 800 gigabits per second and beyond, with roadmaps toward 1.6 terabits and even 3.2 terabits per second. If they can ramp production with their partners in Malaysia and capture even a small slice of that massive market, the upside could be significant. But there are significant risks. POET is not profitable and is burning cash to fund R&D and scale production. In the most recent quarter, they reported a net loss of roughly $12 million on revenue of just over $400,000. That's a considerable loss relative to current revenue, suggesting they're still early in commercialization. Revenue is lumpy and inconsistent from quarter to quarter, which is normal for early-stage tech selling into large enterprise and data center customers, but it adds uncertainty for investors. Some mainstream commentators, including CNBC's Jim Cramer, have said they can't recommend the stock because the company is losing too much money. That reflects broader skepticism about whether POET can turn technology into sustainable profits. They also recently filed to sell nearly 30 million new shares, which could dilute existing shareholders. Execution risk here is enormous. They have to scale manufacturing, maintain high quality, compete with bigger players like Broadcom and Marvell in adjacent areas, and convert tech advantages into growing, repeatable revenue. For investors who believe AI data centers will absolutely need photonic solutions at scale, and who think POET's first-mover position in wafer-level optical interposers gives them an edge, this is a leveraged way to play that thesis. But it's very speculative, and you should treat it as such. The third stock is Nerdy, ticker symbol NERDY, trading around $1.78 per share. This one gives exposure to AI in a totally different space: education. Nerdy operates Varsity Tutors, an AI-driven online education platform offering personalized tutoring and learning solutions. They've rolled out AI-generated lesson plan tools and AI-enabled chat tutoring powered by models like ChatGapt, putting them at the intersection of EdTech and AI. Online education is a vast market that accelerated during the pandemic and has disappeared now that in-person school is back. Nerdy's idea is to use AI to help tutors create custom lesson plans faster and to give students instant, chat-based help that complements human tutoring. This hybrid model, AI plus human, could be attractive to parents and students who want better results without paying a premium for constant one-to-one human time. The low absolute share price makes it accessible for smaller retail investors, and any real business traction can translate into big percentage moves in the stock. But the risks here are serious. There is limited fresh, detailed financial data widely discussed about Nerdy compared to the other two names, and that lack of visibility is itself a risk factor. The EdTech sector has been very volatile. Many companies saw tremendous growth during lockdowns, only to struggle to maintain that pace as life normalized. Competition is intense. Chegg, Khan Academy, and many other platforms are in this space. Nerdy has to prove that its AI features are truly differentiated and that it can retain and grow users profitably. Without precise, up-to-date numbers on revenue growth, margins, and path to profitability, this becomes a high-risk bet on the broad idea that AI will reshape online education and that Nerdy will be one of the winners. Anyone considering the stock should go deep into the latest quarterly reports, earnings calls, and SEC filings before putting money on the line. So, let's wrap this up with a clear, realistic summary. Big Bear. AI gives you exposure to AI in defense and national security, backed by government contracts and a growing tech stack, but with inconsistent growth, significant losses, and valuation risk. POET Technologies offers a leveraged way to play the need for photonic solutions in AI data centers, with strong recent stock performance and industry recognition, but with significant cash burn, dilution risk, and very high execution risk. Nerdy offers a speculative bet on AI-powered education at a very low share price, but with limited current visibility and lots of competition in EdTech. All three of these names trade under or near $5 and fall into penny stock territory, with all the usual warnings: high volatility, potential manipulation, lower liquidity, and higher risk. These are not stocks for conservative investors, and not for money you can't afford to lose. But each one provides a different angle on the AI theme, at a price level where, if the business executes, the upside can be asymmetric. If you're thinking about adding speculative AI positions to a diversified portfolio in 2025, these three might deserve a spot on your watchlist. Not as guaranteed winners, but as high-risk, high-reward ideas. Do your homework. Read the 10Qs and 10Ks. Follow quarterly results. Understand the contract pipelines and balance sheets, and always use position sizing and, if appropriate, stop losses to protect your capital. If you found this analysis helpful, hit that like button and subscribe. I regularly break down under-the-radar opportunities with real data and no hype. Drop a comment and tell me which of these three you think has the most potential, or if there's another cheap AI stock you want me to analyze next. Thanks for watching, and I'll see you in the next one.